Morning, crew. Morning. A few people jumped on already, which is awesome. Thanks for joining me. Another Wealth Coffee Chat here on a thankful Thursday. Hey, Luke. Good morning to you. Rodney, Paul, Allison, Jeff, Aaron, Fiona. How are you, Fiona? Rivier's coming along nicely. Yes, indeed, Allison. You'll be pretty happy with that one when I think it lands. So, yes. Nice to see all of you guys. Thanks, Kylie. It's actually a bit scruffy. Anyway, I'm a bit lazy when it comes to shaving, so I'm letting it grow. It's starting to annoy me now, so maybe I'll zoom it off at some point, but maybe on the weekend when I've got some time to be bothered to shave. So there you go. Anyway, thanks for the shout out. Hey, good morning, team, crew. How you doing? Great to see you all on this morning. Do the quick intros as we get going. Jason Witten's my name. There it is. Most of you know that. But if you're new, hello to you. And let us know. Let us know in the chat if you're new. Let us know where you're dialing in from, what's going on for you. You could be one of our new mentoring clients. You could be one of the people wandering along and finding one of these lives and subscribed. Whatever it is, let us know. Say hello. Love to hear from you. Hey, good morning to you, Carl. Jeff, how are you, mate? Yeah, the night shift done. Good to see. So, listen, today I thought we'd talk about something interesting, and I think we'd talk about a little thing that's popped up for me. I'm helping one of my clients these days. I help business owners and high net worth clients build their portfolios as part of my coaching process, and one of my clients is looking to do a little bit of something like the acceleration phase in his portfolio. So, and I thought you guys might find this interesting. So I thought we'd dive into it today. But you saw my headline there. Well, you may not have seen it. You may have just jumped on the live. But the headline this morning saying, who would like an 87% rental yield? Tell me in the chat. Give me a big yes or a hell yes. Who'd like an 87% rental yield on their investment property? Anyone, 5 or 6% is usually pretty good, but like, yep, happy with that. But who would like an 87% rental yield on their investment property? I would. I can tell you that one. Yeah. Very interesting. Me. Absolutely. Yes, for sure. Well, interesting. Helping. I guess is Sharon. Yeah. Wow. Please. Well, it's interesting. So it's kind of it's a true story. I'm going to tell you this example in a minute. So, but I'm going to build the picture here. So you guys have seen this before. The acquisition, the consolidation, the lifestyle phase, and part of this process is using the 7 plans across this period of time. Let's call this 0 to 20 years. Now, you guys know that we have this process where we sort of sit down with you, lay out, the next, piece of the puzzle, piece of the pie for your investment strategy and plan. And we go through these 3 phases. We deploy the 7 plans at certain times. One of the 7 plans is an acceleration plan, acceleration. And usually deployed, here in the world, in the consolidation phase / lifestyle phase. And why is an acceleration plan deployed over there? Because usually this is what happens. You buy a number of properties. We get a few properties under our belt. In the acquisition phase, you guys know this, let's say 4 or 5, 6, whatever it might be, plus a principal place of residence, your own home, that forms part of your asset base. And, over time, we want those values to rise. That's what we want. And that's fantastic. To begin with, often, we do have something we need to take care of, because sometimes those properties or the costs are higher than the gross rent or the net rent off the top. Let's say this is your rental yield here. and we want your rents, to do that as well, right? So that's kind of the visual here, and what we look for an acceleration opportunity, which acceleration means using some of the assets, the value you have, to take a little bit more risk. Mining town. Well, we used to do mining towns back in the day, Jeff, and we had some significant rental yields, yes. But what we look for as an indicator for you and me to say, all right, can I take some more risk, okay, and higher risk activities? Can I invest in some styles of property, styles of investing that might carry a bit more risk, might carry a bit more uncertainty, and we need to make sure that the gap of our wealth and income is large enough for us to not be emotionally or mentally stressed about it, right? So over here, when you're scrapping around in the acquisition phase, and if you lost 100K, right? If you lost 100K because you did something and it didn't work out in the acquisition phase in the early days, tell me right now in the chat, if you're in acquisitions right now and you put 100K of your hard-earned cash and equity into a deal and it choked and you lost it, would that be a significant setback to you as an investor? Put that in the chat. Like shit, my whole entire net wealth right now is 300 grand. Yeah, ouches. Yeah, exactly, Nintendo. So let's say, over at the start, we might only have 200, 300, 150 grand of equity or cash available to us in free equity to deploy. So that's why in this stage we would, this is part of our teachings anyway, residential real estate, it's going to be filthy, right? So residential real estate is very, very reliable in comparison to a lot of investment vehicles. But over here, now let's say the gap between what you owe and what you're worth is pretty significant. Let me just quickly do something here. I'll show you what this might look like, right? So let's go over the share screen. And let's see up here, I've got a simple portfolio in here. You guys have seen me show you this before. And look up the top here. Let's say in 20 years' time, folks, that you've got equity. And I've got heaps of clients like this, by the way. So a lot of, maybe some of you sitting there going, shit, that'll never happen for me. No, it'll absolutely happen for you. The number one thing for that is time, and we're going to talk about that. But let's say you've got 6 million in equity now. Let's go. You've got 6 million in equity. All right, you got 6 million in equity. Stick with me, follow with me here. You got 6 million in equity after you've owned your properties for a while. Hey, morning, Megan. And now you invested 100K over here, and you've got 6 million to play with. Now we don't want to lose money. Like that is like it's you don't want to be frivolous with your cash, no matter how much you got. But if you lost 100K and you had 6 million in equity, as an impact, a true impact, you'd probably still be filthy about it, Fiona. Is it the end of the world for you? Is it going to be such an impact? Right? Put that in the chat for me. So when we do take risk or we do choose some acceleration strategies, team, we need to know that, what that risk is and what the reward is. And, if it went wrong, would it, end the world, derail you? And the answer should be no. And if the answer is not no, if the answer is maybe or yes, it would derail me, then you're not doing higher risk deals, okay? All right, so now I've laid the plan out there for acceleration. And you guys know there's a few styles of things that I like for acceleration in the world with our income engine. You've got your residential rents, you've got your commercial rents, you've got your stock market down here, and then you've got other stuff like JVs, right? So this is the kind of stuff that we're talking about. Now, what can we do? There's my question to you. If we're not going to do higher risk things over here, okay, so as we go this way, the risk increases, okay, for potential challenges or problems. What can we do? Tell me in the chat, what can we do to our existing residential real estate if it's in the right location and the right type of property and stuff? What can we do to accelerate its income? What's one of the easiest things that I've talked about in the last little while for income acceleration, especially for an existing property that you own? Put that in the chat for me, because then I'll get on with the conversation rather than keeping you guys in suspense about an 87% rental yield. Anyone know? Chuck that in the chat for me. Certainly renovate, Trace, for sure. Airbnb, yes, 100%. You always keep your properties up to date. Short-term, Airbnb. Let's have a look at this. So let's have a look at this. This is pretty cool. I'm helping one of my clients right now. Deploy some of his equity into some lifestyle properties as part of his portfolio. Now, he wants to own a property near the beach, nice little two-bedder near the beach that he can Airbnb short-term let and use sometimes as well. And he wants to own a property in the countryside, a bit of a bush block where he can, take the kids and ride the motorbikes and have camping and stuff like that, right? So he has now, over time created a pretty significant property portfolio. He's got that many, many millions of dollars worth of equity. He's been, going 25, 30 years with his portfolio, and now he's sort of doing some consolidation lifestyle maneuvers, right? So check this out. This is one of the locations he wanted to have a look at. So I'm doing some research for him down in a place called Gerringong, right? I don't know if anyone knows Gerringong, but have a little look. So have a check out this. This is just a two-bedroom property. Just a two-bedroom, nice little two-bedroom unit. In the middle of town, you can see the ocean, which is nice, right? And you can see here, this is where it is. It's still a fair way from, the ocean. It's not right on the beach and stuff like that. But check out the revenue. Check out the income he's getting from that. So tell me right now, like a two-bedroom unit, folks, the day rate, the average day rate is $461 a day. Yep, it's $461 a day. You heard it. An 80% occupancy down there on this little two-bedroom unit, $84,000 worth of revenue. Who'd like $84,000 worth of revenue from a simple two-bedroom apartment? All right? Who would like that? Check it out. Nice little return, all right? Now, here comes the stinger. Here comes the lesson in this conversation. We talked about a 76% rental yield, all right? Okay? Yep. We talked about a 76% rental yield. Here's where the kicker comes in. Because you know what? Every single one of us can end up with ludicrous on paper returns based on our purchase price of a property, all right? But it all depends on one thing, all right? Tell me what one thing you think that this principle that I say all the time, leads to a 76% rental yield on this property. What's that principle? And you can shorthand it if you want to, okay? Time. Absolutely. Time. The underlying principle is quality, yes. Time in the market, for sure. Buy well, never sell. James, you get the sticker of the day. All right, check this out, team. All right, so let's have a look at this property and let's have a look at its sales history. Now, this person who bought it in 1991, how many years is that now? 91. What's that? 30 years, right? 32 years. What's that? 32 years? Is that right? I should have worked this out earlier. I'll do my math on me, right? Buy well, never sell. The BWNS. All right, I love it, right? Now, if this person who bought it in 1991, folks, kept the bloody thing, they would have, what do you reckon? If you bought this in 1991 for $96,000, you reckon you would have paid the bloody thing off? Yes, you would have, right? It would be debt-free, and based on the purchase price, you would be getting an 87% rental yield. $96,000. Hey, ludicrous. Who would like to buy, like you go back 30 years ago, and shit, look at that. Look at that price, huh? 31 years. Thanks, Trace. I'll try and get my calculator out to make my point here. 31 years, folks. 31 years. The price, the value of that property, arguably $1.6 million today, right? 2020, probably a bit more now, 2022. Okay. It'd be debt-free, 87% rental yield against its original purchase price and worth $1.6 million. That is why I say these things. 30 years, buy well, never sell. It'll blow your mind if you just keep the damn properties. Jesus. All right, there you go. But, what happens if you bought it in 1996? Well, 70% rental return. That's what happens, right? With this sort of stuff, time comes along and makes it work for you. So if we've got, 220, 2022 minus 1996, that's 26 years. All right, 26 years, still pretty good return. 2011, I'm still pretty happy with that. I'd be still pretty happy with that one. 2011, 11 years. That's not a bad return in 11 years as well. Still double digits on 11 years. But if you bought it today, this is today, or well, close enough to today, folks, anyway, you'd be getting a 5% yield. And imagine renting that normal at $1.6 million. You'd probably be getting a 1% yield. So hopefully this makes sense when I'm trying to make a point here today with this thing is, the time we spend owning these properties and the future, this gap, this time, 20 to 30 years, it feels like a long time. It does. I mean, I grant you. Like, holy crap, that's going to take forever to get there. But, what else are you going to do? That's what I say. Listen, buy your properties, leave them alone. And if you want to do something more, interesting, take a higher risk, start a business, do some other stuff, that's perfectly fine. But don't cut your properties off at the knees and sell them and then try and do something high risk and lose the money. Do both, but separate them from a risk point of view. That's my opinion anyway. So there you go. So I think this is pretty cool. The idea that you can own these properties and accelerate them through short-term letting. All right? Yep. Yeah, exactly. 900K of growth in 9 years. Take that every other week. Absolutely, Luke. And that's what I'm saying, right? But check out this. And here's the other little thing that's really awesome. I want to show you guys just as we, bring this into a close. Here's the research software that we use. We do this for many of our clients. But check out this. I want you to tell me, what do you think? In this area, so you see this whole area, what would be the highest? Tell me dollars-wise. So we just saw $84,000. Tell me, what would be the highest income in this area? You see all these dots, little farmhouses, little apartments and stuff like that. 131 active short-term rentals down that way, down that neck of the woods. Have a guess. Put it in the chat for me as we finish up here. What is the highest rental in this area? The highest earnings in this area. Tell me what you think. In 1 year, how much money do you think one property down there has made for the owners? Put that in the chat. This will blow your mind. Blow your mind. All right, chuck it in the chat for me. Have a few guesses while I have a little sip of my coffee. Tell me what you think. All right, we're talking 84 grand there. What do you reckon in this area? The highest short-term letting income for 12 months. Luke's going at 150. We got 115. Any in the chat for me? Looks like my internet's doing something weird here. All right, we're back. Internet's back. All right, we got 120. All right, you guys are pretty conservative. Check this out. I want to show you this. Like this one here. Where is it? Can you guys see that? I'm pretty sure. Let's see if I can bring it down a bit. Hang on. I'm going to bring it down a bit here. Who can see that? Tell me what that number is right there. Tell me what that number is. Tell me what that number is, folks. Can you see it? $546,000 from one property on short-term letting. 546 grand. Look at that number. Holy crap. I'm not kidding, brother. Now, listen, this is what I'm saying, team. Luke and you guys, like when we own some damn fine real estate into the future, this is what can happen. But if you don't own them for long enough, I'm telling you, you just don't get an opportunity to see what's going on. Let's have a look at the top properties in the city of Kiama. There we go. Look at this one. This one here. Check out this number. Check out the other one. Actually, there was a better one there. Look, 684,000. 684,000. Anyway, the top 5 or the top 6 properties, 600 grand, 194 to $687,000. Yeehaw. All right, well, there you go. And that's just one spot in Kiama, folks. So imagine when you're building your portfolio and we're talking about, buying quality properties, making sure you got good outlooks, thinking about what you could accelerate that stuff in the future with. Yeah, this is the thing. Imagine having one awesome property. It's a marathon, not a sprint. Dead right, Alison. Imagine having one awesome property that you could, accelerate $100,000, $200,000, $300,000 worth of income short-term letting. I wouldn't do it on all of my properties. I wouldn't do that. I think that'd be way too risky in your portfolio unless you can handle that risk and skill, or not skill, but stress. But, let's say you've got 5 or 6 properties and you've got one that you specifically purchased for at the right time, you're going to accelerate, double, triple, quadruple that income. That's going to be pretty nice in your portfolio, folks. Let's do this. Anyway, there you go. There you go. Absolutely, Trace. We've got some ideas in there. We do helping people find and buy these things through the property management business that we run. We help people manage them as well. So we might let you guys know what that looks like at some point. But again, it's a higher, it's a little bit more risk and stress. You've got to fit out these properties. You've got to spend tens of thousands on furniture. You've got to do the bookings. Sometimes it takes years for them to get known and get rebooked, right? So I'm telling you, these incomes, probably these things have been going for 5 years. Do you know what I mean? So, So the R&W business, Trace, we run the property management in Brisbane and Melbourne, and we do the short-term letting as well with a number of properties. So we might let you guys know what we're up to with that stuff. Maybe next time. Yep. Maybe property number 4. Absolutely, Alison. I would say for every single one of us here with our portfolios, if you have 1 or 2 of your properties in mind for, short-term letting acceleration, then, that really helps with your income and your acceleration in your portfolio, And if you could get to 1 soon, it can help with debt reduction really well as well. So there you go. Anyway, thought that'd be interesting to talk about this morning. Wealth Coffee Chat done and dusted for, absolutely. Yep. Palm Cove's a good spot. Trace, give your coach a shout out. We can do some Airbnb research for you about, what, where, when, what the competition is and stuff like that. So, happy days. Happy days. All right, folks, that's it. Done and dusted. Hope you're well. Hope you had fun. Hopefully that was useful. And as always, leave us a little comment in the chat if there's something that you'd be interested in me covering. All right, team. Have an awesome day. You guys be awesome. Bye for now. Adios.